What are financial ratios? Financial ratios are created with the use of numerical values taken from financial statements to gain meaningful information about a company. The numbers found on a company's financial statements, our balance sheet, income and cash flow statements, are used to perform quantitative analysis and assess a company's liquidity, leverage, growth, margins, profitability, rates of return, valuation, and so much more. Financial ratios are grouped into the following categories: liquidity ratios, leverage ratios, efficiency ratios, profitability ratios, and market value ratios. Analysis of financial ratios serves two main purposes. 1. Track company performance. Determining individual financial ratios per period and tracking the change in their values over time is done to spot trends that may be developing in a company. For example, an increasing debt-to-asset ratio may indicate that a company is overburdened with debt and may eventually be facing default risk. 2. Make comparative judgments regarding company performance. Comparing financial ratios with that of major competitors is done to identify whether a company is performing better or worse than the industry average. For example, comparing the return on assets between companies helps an analyst or investor to determine which company is making the most efficient use of its assets. Users of financial ratios include parties external and internal to the company. External users: financial analysts, retail investors, creditors, competitors, tax authorities, regulatory authorities, and industry observers. Internal users: management team, employees, and owners. Let's look at them one by one to understand what they are telling us and how we can use this information to improve our business in 2022. Next, liquidity ratios. What are they? How to evaluate them? And how to use this information to support you to be the greatest you can be.